If you're starting from zero, no savings, no investments, maybe even some debt, the biggest mistake you can make is investing in the wrong order. Most people jump into stocks, crypto, or real estate because it feels exciting, but wealth isn't built on excitement, it's built on structure. If you don't follow the right sequence, even hardworking people stay financially stuck for years. So the first thing you need is not stocks, not passive income, not side hustles, it's an emergency fund. 3 to 6 months of living expenses saved in cash. Because life doesn't care about your investing plans. Cars break down, jobs disappear, unexpected bills show up. Without cash, every small problem turns into a crisis and you're forced to sell investments or take on more debt. Investing without protection isn't smart, it's gambling. Stability always comes before growth. Once you've built that safety net, the next step is eliminating high-interest debt. If you're paying 18% or 20% interest on credit cards, investing makes no mathematical sense. If your investments earn 8% but your debt costs 20%, you're moving backwards. Paying off high-interest debt is a guaranteed return equal to the interest rate. It's not flashy, but it's powerful. When debt disappears, your income finally becomes yours again instead of the bank's, and that breathing room reduces stress and increases momentum. After protection and debt freedom, step 3 is capturing free money. If your employer offers a retirement match and you're not taking it, you're literally refusing part of your salary. That match is an instant 100% return. No risk. No strategy. Just free growth. This is where compounding quietly begins. At first it feels small, almost insignificant, but over time compounding becomes a force that works harder than you ever could. The earlier you start, the more powerful it becomes. Only after these steps do you move into serious investing. Step 4 is low-cost, diversified index funds. Not day trading. Not chasing trends. Not gambling on whatever is popular this month. The truth is most professional investors fail to beat the market long-term, so instead of trying to outsmart the system, you own the system. Index funds are simple, boring, and historically effective. Consistent monthly investing over decades, even at average returns, can grow into hundreds of thousands of dollars. Wealth isn't usually explosive, it compounds quietly through discipline and time. Finally, step 5 is upgrading your strategy. Once your foundation is strong, you can increase contributions, explore real estate, start a business, or take calculated risks. But now you're operating from strength, not desperation. Most people start here while skipping the basics, and that's why they feel constant financial stress. Growth without stability creates anxiety, but growth built on stability creates confidence. When you follow this order, you won't get rich overnight, but you will stop being financially fragile. And once you're no longer fragile, wealth becomes a natural result of patience, structure, and consistency. The goal isn't to look rich quickly. The goal is to build a system that makes wealth inevitable over time.